Institutions don't just move price, they create imbalances in the market, known as fair value gaps. These gaps reveal where price moved too fast, leaving inefficiencies that the market later seeks to fill. It helps you see where institutional orders are likely placed, where retracements will occur, and where high-probability entries are hiding in plain sight. In this video, we're going to talk about fair value gaps, also known as imbalances. We'll break down what they are, the psychology behind their formation, how to identify a valid fair value gap, and how fair value gap inversion can signal powerful trading opportunities. If you are interested in learning advanced trading concepts, strategies, entry techniques, and how to control your trading psychology to stay disciplined in your trading journey, make sure to hit the like button to show your support, and subscribe to the channel if you're new here. A fair value gap, often called an imbalance or inefficiency, forms when price moves too quickly in one direction, leaving an unfilled space on the chart where buying and selling were not balanced. It usually happens when large institutional orders enter the market, causing price to move aggressively without giving the opposite side a fair chance to trade. Technically, a fair value gap is identified by three candles pattern. It forms when there's a visible gap between the wick of the first candle and the wick of the third candle, and these two wicks do not overlap each other. In an up move, the third candle's low stays above the first candle's high. In a down move, the third candle's high stays below the first candle's low. This gap represents inefficiency, an area where price moved too fast and skipped fair value trading between buyers and sellers. That's why we call it an imbalance. There weren't enough sellers to match all the buy orders, or vice versa. And since the market always seeks balance, price often returns later to fill that gap, completing unfinished business before continuing its move. The story of smart money and retail traders reacting very differently to the same market move. To understand the psychology behind imbalance, we need to think about how institutions and retail traders operate. When smart money, like banks or hedge funds, decide to enter a large position, they can't just click buy or sell once. Their orders are massive, and placing them all at once would move the market too much. So instead, they execute in phases. The first push is a strong displacement move, where price explodes in one direction, creating that imbalance or FVG. This initial move helps them break structure and trap liquidity from retail traders who are caught on the wrong side. At this moment, retail traders see the strong candle and think, "Wow, the market is flying. Let's jump in before it's too late." But they're entering after the smart money has already made its move. What happens next? Institutions let price pull back, returning to the fair value gap they created, so they can fill the rest of their unfilled orders at a better price, right before continuing in their intended direction. This is the psychology behind every FVG. Smart money creates the imbalance. Retail traders chase the move. Then price returns to rebalance, giving institutions their ideal re-entry and leaving retail traders confused. Understanding this psychology helps you stop being the one trapped by the market, and start trading with the flow of institutional logic. Now that we understand both the technical and psychological side of FVGs, the next question is: how do we spot a valid fair value gap, and how do we mark it the right way? A valid FVG must form after a large, impulsive candle, usually with long body and small wicks. This shows that price moved quickly with strong momentum, driven by institutional orders, not random noise. As mentioned earlier, the gap should appear between the first and third candle's wick, where they don't overlap. But it's not necessary that the three candles pattern will always be consecutive. There are some tricky situations. Consider this price chart. Most traders will look at the last three consecutive candles and immediately label them as the first, second, and third candles, then mark the fair value gap from the low of the first candle to the high of the third candle. But that's actually not the correct way to identify a valid fair value gap. If we take a closer look to the left-hand side of the chart, we can see a bullish candle whose low and high are protected, meaning, the following candles did not break either its low or its high. When this happens, all the price movements that occur within that candle's range are considered internal moves. Therefore, we mark this bearish candle as our first candle, because its highs and lows are untouched. The candle that breaks the high of this first candle will then be marked as the second candle, and the candle that follows it becomes the third candle. In this case, the valid fair value gap is measured from the high of the first candle to the low of the third candle. It's important to remember that internal price movements, the ones that occur inside the protected candle's range, should not be considered when marking the imbalance. Now let's look at another scenario. If the following bearish candle breaks the high of the previous bullish candle, we now consider this bearish candle as our first candle in the fair value gap pattern. The reason is simple: now its high and low become protected. From here, the imbalance is identified and marked from the high of this first candle to the low of the third candle. But if the next candle that forms goes on to break the low of this bearish candle, then that candle is considered the first candle, and from there we can continue the same process to identify our valid fair value gap. When a FVG appears together with other smart money concepts, such as an order block or a liquidity sweep, that's when it transforms from a simple imbalance into a high-probability trading opportunity. We're not going to dive deep into order blocks or liquidity sweeps in this video; those topics will be covered in detail in the upcoming videos. A fair value gap shows us where price moved inefficiently, but when that imbalance aligns with an order block or follows a liquidity sweep, it confirms that smart money is active in that area. It means institutions have likely engineered liquidity, created displacement, and are now preparing for continuation or reversal, all within that same zone. If price does not respect the imbalance and instead breaks beyond it, the fair value gap can invert its role. In other words, what was once a resistive imbalance in a bearish move can now act as a support zone, and vice versa. This inversion often signals a potential shift in market structure or a change in institutional intention. This behavior is what we call a fair value gap inversion, and understanding it can help you recognize where the market is likely to reverse with precision. A fair value gap inversion occurs when price breaks through an existing imbalance and then later retests that same area from the opposite side. In other words, the market flips the purpose of that imbalance. A bullish fair value gap, once violated, can act as bearish resistance. A bearish FVG, once broken, can turn into bullish support. This inversion represents a shift in market intent, the point where smart money transitions from one side of the market to the other. It tells us that the orders which once drove the imbalance have now been fully mitigated, and the market is using that area to engineer liquidity in the opposite direction. The key to mastering fair value gaps is practice and backtesting. Go through your charts, study how price reacts to imbalance, and notice how often they align with higher timeframe structure. When you combine fair value gaps with higher timeframe confluence, your accuracy improves and your confidence grows. Stay consistent, keep refining your approach, and over time, the results will naturally shift in your favor. If you found this video helpful, don't forget to like, subscribe, and hit that bell icon so you never miss our next video. If you have any question, drop it in the comment below. Thanks for watching, see you in the next video.